Welcome to The Explainer. Today, we're diving into a major headache for S-Corp owners. And that's the reason why you can't always deduct your business losses on your personal tax return. Look, the IRS has a very specific set of rules you have to follow. And if you don't, those deductions disappear. So let's break it down.
So this is at the heart of so many frustrating letters from the IRS. I mean, it seems totally simple, right? Your business lost money, so you should be able to deduct that loss. But it turns out it is absolutely not that straightforward. You see, the IRS makes a huge distinction between a loss happening on paper and you actually getting the tax deduction. They are two very different things. And here's the core concept you have to get your head around. The tax code basically says, okay, you're the shareholder, we'll allocate this loss to you. It's yours. But then it immediately puts up a series of roadblocks or hurdles that you personally have to clear. And only after you've jumped through every single one of these hoops can you actually use that loss to lower your taxes. Okay, so here's our game plan for today. We're going to start with the main problem for shareholders. Then we'll walk through the first big hurdle, which is called basis. After that, we tackle the second one, the at-risk rules. We'll also look at some really common traps where these two concepts get all mixed up. And finally, we'll cover how you're supposed to manage any losses that get stuck along the way. So let's get right into hurdle number one.
All right, let's get into the first and honestly, the most fundamental hurdle, your tax basis. This is square one for any loss deduction. And the specific rule we're looking at here is found in the Internal Revenue Code, Section 1366.
So what exactly is basis? Well, you can think of it as the IRS's official scorecard for your real investment in the company. The rule in Section 1366 is incredibly strict. You can only deduct losses up to the total of 1, your stock basis, which is pretty much the cash you've put in for stock, and 2, your debt basis, which is any real loan you personally made directly to your S-Corp.
Now, this right here is a huge source of confusion, especially for anyone who's ever dealt with a partnership. See, partners can often increase their basis by their share of the partnership's bank loans. But for you, the S-Corp owner, that's a hard no. You get absolutely zero basis for any loans the corporation takes out from a bank or any other third party. For tax purposes, the S-Corp's debt is not your debt. And this all leads us to the core legal idea that holds this all together, the Economic Outlay Doctrine. The IRS and the courts are basically asking one simple question. Have you made an actual economic outlay? To get basis, you must have put your own money on the line in a way that actually makes you poorer in a material sense. It's all about having real skin in the game. So here's where people get it wrong time and time again. Just promising to pay later isn't enough. Look at this list. Guaranteeing a bank loan? Nope, that doesn't create basis because you haven't actually spent any of your own money yet. You're just a backstop. Signing as a co-borrower, same problem. To get that precious basis, you have to be the one who actually writes the check to your corporation. So let's move on to the next hurdle, because here's the tricky part. Even if you do everything right and successfully create basis, your loss might still be trapped. This is the at-risk limitation, and it's governed by Internal Revenue Code Section 465. You know, to really understand the at-risk rules, you have to go back to the 1970s. These rules were created specifically to shut down abusive tax shelters, where people were taking these massive deductions without actually risking any of their own money. So while the basis rule asks how much you have in the game, this at-risk rule asks a different question. Yeah, but could you really lose that money? It's a completely separate test. So your amount at risk is exactly what it sounds like. It's the capital you truly stand to lose if things go south. And the code is very specific here. It carves out any amounts where you're protected from loss. This could be things like non-recourse debt, where a lender can only take the collateral, or any other kind of guarantee or stop-loss agreement that shields you from the economic pain of that loss. And this visual right here gets to the heart of the most common trap. It is absolutely possible to clear that first hurdle, to have basis, but then get stopped cold by the at-risk test. Just because your money is technically in the business doesn't automatically mean the IRS considers it truly at risk. Okay, let's explore two specific, pretty technical scenarios where these two sets of rules go in different directions, creating some nasty traps for shareholders who aren't paying close attention. The first trap is what we call the related party lender rule. Section 465 is crystal clear about this. You are not considered at risk for any money you borrow from someone else who also owns a piece of the business, like another shareholder. Why? Because the government looks at that and just sees money moving around in a circle. There's no real new risk being introduced to the system. Let's walk through this classic back-to-back loan example. Shareholder A borrows 50 grand from shareholder B. Then A turns around and lends that same 50 grand to their S-Corp. Now, when we look at this through the lens of the basis rules under Section 1366, it works. It's a pass. Shareholder A really did lend the money to the company, so they get $50,000 of debt basis. But when we apply the at-risk rules from Section 465, it's a fail. Because the money originally came from another owner, shareholder A isn't considered at risk for that $50,000, and any loss connected to it gets stuck. Now, for a particularly dangerous part of the at-risk rules, this is the recapture rule under Internal Revenue Code Section 465E. And honestly, you should think of this as a ticking time bomb. Here's how it can blow up on you. Let's say in year one, you have a $50,000 at-risk amount, and you use it to deduct a $50,000 loss. Great, your at-risk amount is now zero. But then in year two, you take a $10,000 cash distribution. Now, this might be tax-free for basis purposes, but it drives your at-risk amount below zero to negative $10,000. The result under Section 465E is brutal and immediate. You must recapture that negative $10,000 and report it as ordinary income, even if the company was completely unprofitable. You're literally paying tax on phantom income. So, with all these rules, how in the world do you keep it all straight? Well, the best way I've found is to visualize your suspended losses as being held in three completely separate and distinct buckets. Okay, so losses that are suspended because you don't have enough basis, they go in bucket A. You can only unlock these by making a direct economic outlay, more capital, a direct loan. Losses that clear basis but get stopped by the at-risk rules, they go in bucket B. You unlock these by increasing your personal economic risk. Now, the third bucket, for passive activity losses, is a whole other topic, but the crucial point is this: you have to track these buckets separately. You cannot unlock a loss in bucket B by fixing a problem in bucket A. And remember, you absolutely must apply these limitations in this specific mandatory order. It's a gauntlet. First, a loss is tested against your basis under Section 1366. If it passes, it moves on and gets tested against your at-risk amount under Section 465. Only then is it tested against the passive activity rules of Section 469, and finally the excess business loss limitation of Section 461L. A loss has to clear one hurdle before it can even attempt the next one. So, if we boil all of this down to one essential takeaway, it's this: to deduct a loss, you cannot just be a backstop for your corporation. You have to fundamentally change your economic position from that of a guarantor, someone who just promises to pay later, to a direct investor or a direct lender who has already put their own capital on the line. And you should know the IRS is no longer just taking your word for it. With the introduction of Form 7203, which became effective for the 2021 tax year, all S-Corp shareholders who are claiming losses or taking distributions must file a detailed year-by-year calculation of both their stock and debt basis. The era of informal or estimated basis calculations is definitively over. Which brings us right back to that central question. This isn't about what the company's books say or what you think you have invested. It all comes down to what you, the shareholder, have personally and economically put on the line and could truly lose. That is the question the tax code is asking, and now you know exactly how the IRS expects you to answer it.